Great. All right. 3, 2, 1. Hi, this is Daniel with Unrivaled Investing. Today we're going to talk about the Trade Desk, an exceptional company, a fantastic stock over the last few years. Let's dig in. Here's a disclaimer. You can read it on your own time. So before digging into what they do, what is the Trade Desk, what's their background, I personally have a little bit of a history with the Trade Desk. I started investing in it in late 2017, early 2018. I put in about $20,000. You can see some of my trade history where I was buying it around 45, somewhere between $45 and $55 a share. Most recently, it was around $465 to $500 a share. So in less than 3 years, it's made a 10x return. So if you're interested in finding potential multi-baggers like this, hit that subscribe button. My mission is to help you on your financial journey, whether or not you've saved millions of dollars and you're retired, or you're a small investor just starting to figure it out. My goal is to educate you by sharing you my own personal financial journey, and some of which it has done exceptionally well. Sometimes it doesn't work out as well as the Trade Desk. My focus is to do this through the lens of finding potential multi-baggers. Multi-baggers are companies that can go up hundreds or even thousands of percent over time. And I sort of further focus that lens so I start from multi-baggers, I move in by trying to find companies with a UVP, or company with an unrivaled value proposition. When you have an unrivaled value proposition, it means you offer a good or service that you simply can't get elsewhere. And when you have this UVP, it gives you the right to win, and you dominate a market. I think the Trade Desk is one of these types of companies. If this type of dialogue, this is the type of content that you're interested in, hit that subscribe button now, or if you're already a subscriber, hit that like button. Thanks. So what's the goal of this video on the Trade Desk? First is it's an introduction. What do they do? Second, do they have an unrivaled value proposition? If so, what is it? Why do they have it? What's their market potential? How are they performing in 2020? I mean, we're in the middle of a global depression / pandemic. And then last is, what are sort of the thoughts on the valuation, the risk reward? Is this another 10x potential from here? Let's dig in. So what does the Trade Desk do? They provide software. They provide a software platform for advertising agencies to programmatically bid on nearly any digital advertising inventory in the world. Now, what is programmatic advertising? It's the automated or electronic buying and selling of advertising spend, or of advertising. So let's dig in a little bit. So what's driving programmatic advertising? A couple of components. First is a big broader trend, which is the fragmentation of supply. We're no longer in the world that you saw, decades ago, where there are three, network channels on TV. But now countless viewers, countless different outlets like mobile apps, websites, media players, connected TV. There's all these different new channels from which a viewer can look at an advertisement. And so that if you want to be able to effectively reach these consumers, you need to have an algorithm help you figure out what you should pay for each of these different mediums, because each of them will have different click-through rates, different return on investment. And clearly the Trade Desk is there to partner with those ad agencies. So the ad agencies work with the brand, the Trade Desk works with the ad agencies, so that way they can figure out how to spend the money. So this company is not a disruptor, it's an enabler. They're enabling those ad agencies to better figure out how to allocate their capital when a brand wants to either have brand spend or target a particular launch of a product. So that's the first component, the fragmentation of supply. The next is the decreasing digital media, or excuse me, the increasing digital media and data, where it's enabling options for advertisers to target and measure their ad campaigns across every media channel. That's sort of what I was targeting, what I mentioned earlier. But now this is no longer the age of Mad Men, where it's based on a relationship, and oh, I know someone at this magazine and we're going to put an ad here, and this magazine reaches X number of people. No, this is very precise, laser precise targeting of individuals looking at the data on a per individual basis, per impression basis, to figure out what should this ad agency bid on this ad inventory to reach you. And that this is not a stagnant, pricing system. This is a electronic dynamic pricing system. And so if you want to live in the modern day age of precise, better return on investment advertising, you simply need program, pro, program, programmatic advertising, programmatic advertising. And so you see this automation of inventory and ad buying where it's leading to better price discovery, better return on investment, and it's spread across billions and billions of impressions, so ad impressions every day. Programmatic, man, what a mouthful. Or said another way, what we do is we provide a self-service platform to agencies who deliberately pick from over 500 billion digital ad opportunities a day. Think about that, 500 billion digital ad opportunities a day. They're scanning across all these, across devices, across mediums, to figure out what this ad agency should be paying and what they'd be willing to bid for these different inventory slots. And then the second component here that they call out is that 95% of our spend comes through MSAs. MSAs are master service agreements. And so the reason why this is important is this implies that they have a tight-knit relationship where it's an agreement with the agency where they're saying, look, we have an agreement where we can spend, and when you have an agreement like this, you generally have some sort of continuous repeat purchases year after year, and we're going to get a little bit more into that in the upcoming slides. So does the trade desk, so we've covered what they do from a high level perspective, but do they have an unrivaled value proposition? I think so. One of which is the strong relationships with the top ad agencies, or having these master service agreements, with these agencies. So that's the first step, is they have the relationships with these top agencies. Part one. Part two is these agencies are the gatekeepers to these major brands. And, these brands are trusting these gatekeepers, these ad agencies. So there's a loyalty aspect, and trust is a huge factor. And this is partly where, the trade desk comes in, is that you want to make sure that your advertisements aren't showing up where they shouldn't be. I'm sure you can think of plenty of, content on the internet where a premium brand does not want to have their advertisement placed. So that's working with the trade desk, working with these ad agencies to make sure that doesn't happen. So this is a key aspect. And once you have trust of a major multi-billion-dollar brand, you don't want to violate that trust. You're not going to go with some startup on trying to figure out how to spend your millions of dollars ad budget. So that's the first part. Another part is they have strong relationships with the supply side. So not only do they have a strong relationships with the demand side, and keep in mind, they're enabling the demand, the ad agencies. They have strong relationships with the supply side, so the publishing side, all these websites, or these apps, anyone who has ad inventory space that they're looking to sell. And keep in mind, you need to have scale to connect to the supply side. This is a point that a lot of people don't get, but when I read it in the 10K back in 2017, I was like, whoa, this is really interesting. Let's go on. So this is what they say. We believe that new entrants would find it difficult to gain direct access to inventory providers given their limited scale and the costs that additional integrations impose on inventory providers. This is like, as an investor, this is music to your ears. When you see something like this, like bells are going off, because that means that it's harder for new competitors to enter this space. The trade desk is effectively saying, like, look, once you already have these relationships with the supply, platforms, why are they going to want to link up with a new player? This new player that doesn't represent a lot of demand. Like, they don't want to have to work and set up that integration and ping all their data. Like, that's totally not worth it for them. They'd rather work with the player that already has all the demand. So it's, if you aggregate the demand, you're going to win, and that's what Trade Desk is doing. So and so that's the component from the 10K where they're effectively saying we don't think new players are going to come in and disrupt us. That's a big deal for a future growth perspective. And three, just have a strong platform with cutting edge technology. Scanning literally trillions in ad opportunities is not easy or cheap. Pinging all these every day, every second to figure out exactly how much an ad agency should bid on a per impression basis. That is costly, both from the tech development side as well as from the server costs, constantly doing this. So you can, what I always like to do when I'm trying to suss out, does a company have an unrivaled value proposition, is I start building a thesis myself, but you always need to cross-check it against reality, because it's nice to have a thesis, but what's happening in the real world. And so that's where you see, like, what is the trade desk doing by the numbers. And this is from their presentation, where you can see their revenue growth rate 156%, smoking hot, 78, 52, 55, 39, and then their gross spend. So you can see, so the gross spend, that's the spend that's being spent through their platform. So they have about 3 billion gross spend in 2019, which translated into 600 million in revenue for them. So you can like ballpark, there are a couple of things you should be getting away from this. One is that they're growing way faster than the advertising market. Like the global advertising market, maybe a couple single digits a year at most. US advertising market, certainly, like you're not growing crazy fast advertising market. So when you see this, there's a structural change that the trade desk is winning at. No questions. Like just seeing this data. The other components, so they're taking market share, but you also know from looking at this that their take rate, so aka how much are they taking from every ad dollar spent through them, is about 20%, like ballpark, because there's 3 billion in ad spend in 2019 and they generated 600 million in revenue, 660 million in revenue. So you get a ballpark figure for what their take rate is, what they're charging. 20% on every ad dollar, that means they're delivering real value to these ad agencies. So for every advertising, $1 of advertising spend, 20% going, or 20 cents going to the trade desk, you have to have significant value add if that's the case. And so then this is also from the company presentation, trying to figure out, is there still significant growth in the years ahead? And just look at this. I mean, they're showing that the global ad spend is $725 billion. In the last slide, the amount of demand going through their platform is 3 billion in 2019. So they are less than 1% of global ad spend. So when you see this 30% growth, it suggests, a huge market potential where they could easily be double, triple, 10x their current size in the years ahead. And that's why they put this little billboard thing. I think they're trying to help hit away that they're early innings. This company has a long runway in front of it. We believe advertising will be transacted digitally. The future of all media is digital and programmatic. See, I got it right the first time there. So that's, this makes the case that it's a huge market. They're just barely tapping into it. So one could expect to have very high growth in the years ahead. So how are they performing in 2020? And first of all, I have to check, do I've got that emoji, like eyebrow down? I think I do. Even with the glasses, I think so. I think so. So the results are not great given the global depression and pandemic. Like the revenue the revenue was down 13% in the second quarter 2020. It should say down. So down 13% in the second quarter. Their customer retention, however, was 95%. So the same as usual. So AKA the ad agencies, they're sticking with them. And it's usually not like they're not leaving because they don't like the product. They're leaving generally because they're smaller ad agencies that may go out of business. So seeing revenue down only 13% in the middle of a global depression, that's, it is what it is. It's not great. Could have been worse, could have been better. But it's not great. So let's keep going. So their operating income because you always have to look at revenue, but also flow through. Like, is this company just burning tons of cash? And the trade desk historically was really profitable. Like operating margins, like could be around 30%. So really profitable business model. But in the second quarter, they swung from 32 million operating profit last year to a loss of 16 million in the second quarter. The reason why I prefer looking at operating income, because they also have an adjusted EBITDA figure. I would ignore that if I were you, because the big bulk of the adjustment is stock-based compensation. And it really annoys me when companies do this. Like, stock-based compensation is an expense. Someone is paying it. It may not be a cash expense, but it is definitely an expense as a shareholder. So that's why I prefer looking at operating income in this case, because it's net of stock-based compensation. It is net of depreciation and amortization as well. But you can look at their adjusted EBITDA table and say, like, hey, how much amortization is here, and does it really move the needle? At the end of the day, like in the second quarter, they swung to a fairly minor loss given their cash balance is over 400 million. This is net. So no problemo, I write here. But what about the outlook? Is management expecting in the months or quarters ahead? So here's what they had to say. Our business has been impacted by the COVID-19 pandemic that has significantly impacted advertiser demand. They continue on, assuming that the economy continues to recover and we do not have any major COVID-19 related setbacks that may cause economic conditions to deteriorate. We estimate revenue growth in the third quarter to increase 8 to 10% on a year-over-year basis. Okay, so that's like bing, bing, bing. That gets people excited. That's the reason why Trade Desk stock popped on their second quarter news. Is Wall Street was expecting a huge drop. You only saw a 13% revenue drop. Plus, they're guiding to growth of 8 to 10% in the third quarter. Big deal. Under this assumption, we estimate adjusted EBITDA to be at least 30 million in the third quarter. So, with 20 million in quarterly stock-based compensation, I'm doing ballpark figures. You're still operating at a break even. It's still positive, and it's definitely cash flow positive. So you don't have to worry about that. You still have this huge runway for growth. And at the end of the day, what's funny about the trade desk is that you get a lot of volatility on these quarterly updates, based on what revenue is doing year over year. But what really matters is the fourth quarter, because that's when ad budgets just go crazy. And so, even if the third quarter is better by 2% or worse by 20%, like, it doesn't really matter relative to the fourth quarter. The fourth quarter is like, boom, that's the big numbers. So, but despite the setback of the pandemic, seeing a 13% decline, in top line, they are continuing to make the right investments. And you see that within that 13% decline, they have several growth engines that are just going at full speed. Connected TV is a huge trend. It's been incredible watching and reading about this journey the last few years. A couple of years ago, they were talking about growth of like 1,000% year over year. They're still growing on the connected TV side really fast, up 40% year over year. Mobile video, they highlighted, is up 15%. Audio spend, so think more and more people listening to like the podcasts, the Pandoras, the Spotifys of the world, that was up about 20% spend. So a lot of these channels, the spend is actually up, but on whole, it was down 13%. So this gives you, so far this video has given you an overview of what is the trade desk, what's their value proposition, is it strong, how are they faring year to date in 2020. Now let's dig into valuation, because we've seen that it's been a 10-bagger over the last few years. The question is it going to be a 10-bagger in the years ahead? Because that's obviously what you're probably more interested in, because you're probably looking at the name for the first time. So this is worth digging in. Once again, I got to exercise that eyebrow. The valuation expanded by 5x from the time I bought it here to now. So it went from like 5 times. This is forward sales. Using a sales multiple actually makes life a lot easier, because it removes all sorts of volatility from expenses and taxes and just looks at how are people thinking about the value of this enterprise. So that's a gut way of checking a company. So this is looking at the price of sales on a next 12-month basis. And you can see that it's gone from about 5-6 times when I was buying it to around 25 times today. So valuation has expanded by 5x. One question you should be asking yourself, hence the eyebrow, is, if you're seeing 13% revenue decline, should you really be at close to a all-time high, multiple? I mean, look at this. It's incredible. So 25 times, forward sales, that is rich. And that's driven a lot of this return. And so let's dig in, because this is a part where a lot of investors and even traders, they get so confused on this that it's worthwhile to spell it out. Like, hey, what actually drives your return over time? Because a lot of people think they find an exceptional company, therefore it's going to be a great investment. That is not always the case. You need to value all these different components when you're sizing up an investment. So what are the three components? You got fundamentals, and this is what drove a 10x return in less than 3 years. So fundamentals, 2x. There was literally 100% growth in the fundamentals. Their sales grew by 100%. So that's actually like sort of what I was penciling out. I was like, hey, I think this company could grow at 20-30% a year pretty easily based on how they've done. So getting 100% growth, that was what I expected. Valuation going from 5 times to 25 times, that's a 5x growth. I mean, that far surpasses the fundamentals. So that's how you get 2 times 5 is 10. That's how you get your 10 bagger. This valuation multiplier is just huge. And if you think about it, like, you could have another, well, we'll get into that in a second. But the next part is distributions. Like, you could see, ignore, they're not paying a stock, they're not paying out. So then the next component is like fundamentals times valuation plus your distribution or dividend. That gets to your return. And so having 100% fundamental growth, the valuation expanding by 5 times gets you a 10x. And I'll post a video link below that discusses these major forces and what actually drives big returns in the market over time. Because I've done a video about these very factors, as well as what I think is the secret that most people miss, because it's actually, this is supposed to be the biggest component over time. So what can you figure out that drives that? I've already hinted at it a lot in this video, but I'll post a link below that's a good summary of this. If this is your first time actually thinking about investing from these 3 different buckets: fundamentals, valuation, distributions. But that's in the past. So 10x in the past. Where does the trade desk go from here? And fundamentals, it seems up seems likely. I've articulated huge market. They're at 0.5% or less than a 1% share of a global market. So, could they keep growing 20-30% a year? Yeah, I would think so. I mean, this pandemic is definitely a short-term setback, but I would expect some sort of return to normalcy in the future. The valuation component, it's going to be a huge potential range. I mean, look, it's gone from 5 times sales to 25 times sales. So you could literally have an 80% pullback in valuation that would wipe out years of potential growth that you would expect in the fundamentals. Oh, I know this is a great company. This company's going to keep growing 30% a year. Yeah, doofus, you got to focus on valuation too. People don't like it when I call out like, hey, this great company might be valued at a price where you're going to get substandard returns over time. You got to factor in all 3 of these components: fundamentals, valuation, distribution equals return. So when you look at these things, it's a question mark. Like, you need to be able to pencil out what you think the returns are. In that spirit, my goal is to have unrivaled value for you. So what's my value proposition to you? It's to find multi-baggers, but I want to make it unrivaled. And so in that spirit, I'm going to post a Google Sheet link below in the description of this video, and you can play around with the sheet. You have to download it and, save for yourself, but you can play around with the sheet and put in your own assumptions for what you think the company, what the trade desk you think will do over time. Here's one take. This is something I personally penciled out, is like, hey, this is a wide range of scenarios that I might be willing to underwrite. I'm going to post that link below in the description. You can play with it. It's up to you to decide. Like, I'm not pushing one way or the other. I still own, a small stake in the trade desk. It's not the full stake that I did, when I bought the $20,000 back in 2018. But I'm putting it on you. This is my value proposition to you, is not only am I here to educate you about these companies, I'm giving you the tools for you to figure out if you think it's compelling. I'm going to show you my initial take, but if you think I'm wrong on something, you change it. It's on you. So here's my current thoughts on valuation. You think I'm wrong? God bless, you fix it. So the current market cap is around 22 billion. 2019 sales, 660 million. So this is what they actually did. What is the estimated sales growth? I'm going to put a wide range on this. Like let's give a huge range, -15 to +15. Given that they're guiding to positive growth, of 8 to 10% in the third quarter, and they were down 13%, like in the second quarter, it might be prudent to have this huge range. This is the low, base, high. So the estimated 2020 sales, would get you from 560 million to 760 million. So a price to forward sales multiple of 30 times to 40 times. This is super expensive territory. Like, wake up, folks. This is not 5 times sales when I bought it. So getting that sort of 10-bagger returns could be super tough. Like going from 5 times to 25 times makes your life a lot easier if you're looking for a 10-bagger. So what's the estimating operating margin? I'm ballparking, somewhere between 30 and 40%. Might be higher, might be lower. This is a ballpark based on sort of what they've done historically and sort of looking at their operating expenses, where I think they could potentially get leverage. So operating profit of 170 to 300 million. It's a wide range, but it's also using a range of sales changes. Slap on a 25% tax, and this would be like a hypothetical what they could do earnings in 2020 of like 126 million to 228 million. Then let's assume 5 years growth. 5 years of growth, and let's give a wide range. Once again, this is the low, this is the high. 15% a year annualized, 20% a year, 30% a year. What's that get you in earnings 5 years out? That gets you 250 here, 850 there, and it shows you based on the current market cap what the implied earnings multiple is. So you get like 27 times to 90 times. Like, that's still pretty rich. Even giving some pretty lofty assumptions like 40% operating margin. So you do that, and you see that the ending market cap here is 5 billion, which is almost an 80% drop from where it currently is. This is the low scenario. Like, I'm not saying this is going to happen, but what I'm saying is, like, I would want to underwrite this is a scenario that I think is probable or possible. And so you can see, the ending multiple 20 to 30 times. This is 5 years out. And I'm not saying this year, 5 years out. And at the end of the day, your total estimated price return from owning the stock, keep in mind, this doesn't include distributions or cash paid out, which they could start doing because they are a profitable company. At the end of the day, you're looking at pretty lousy return, risk reward here, like from this scenario of like 12% upside versus 80% downside. It's not that attractive, and that's the reason why I've actually blown out of most of my shares, since then. Did I top tick it all at nearly 500? No, of course not. But has it been a satisfactory investment so far? Yes, it's been more than satisfactory. Do I wish I had invested more? Of course. But do I recognize when something has gone from fairly priced or undervalued to potentially overvalued? I think it's important to recognize that. For those that are, DIY investors that want inspiration for their own financial journey, or they just want to find the next trade desk, go to unrivaledinvesting.com, click Journey. There you can see monthly updates of what I'm buying or selling, companies that I find are interesting. And honestly, a couple of my top 5 positions, even top 10 positions, are companies that could have that sort of 10x profile. Like one of my top 3 is already up like 3x, and honestly, it's just crushing it. Could easily be a 10xer from here. So this is my way of sharing my journey with you. I hope that by sharing my journey with you, it can help you out on your own personal financial journey. Thank you so much for watching. If you enjoy learning about potential multi-baggers, hit that subscribe button or hit that like button. Thank you.